hitting record, and let me share my screen. Okay. See, can you see it?
Yes.
Perfect. Okay. So just to kind of, this is for kind of the little bit of this week and then also coming into next week. So starting up with tomorrow, we have Tanya. She'll be kind of going through the last little bit of what's changed with commands since Mega Camp. So she'll be talking about all new designs and how you can integrate that into your campaigns and websites and stuff like that. And then also tomorrow we have our LARC class. So we've been preparing for that for a while, and a lot of people have been asking for it. So if you are kind of in your last leg of needing to renew your license or just want to get it out of the way before you renew your license, this is required for all agents at some point to get for a license renewal. So the LARC class will be provided here in the office for KWPP, but it will also be Zoomed or be on Zoom for people who find that to be more convenient or comfortable. But it's also going to have other Keller Williams offices on that as well. So, but for us, we're fortunate to have it in person. And I think, yeah, Kim Wilder will be providing, and WFG will be providing food for those who attend in person. So there's a little incentive, but we have about 20 people that can fit in the office or in the training room. And so that'll be good. And then let's see real quick. I think, let me pull out, just want to check something, just make sure everybody's muted. All right, we're good. Sorry, thought I heard something. So going on with Monday, oh, actually going back to the LARC class. So we did send out an email this weekend. There's two ways to register. There's one to register online. There's a link that you will register typically like you do with most Zoom classes, but there's also an RSVP for in person. So if you're coming in person, be sure to email Kim and RSVP with her just so she gets a head count and knows how many people are going to be here, just so we don't go overboard with the amount of people. And so going into Monday next week, we're continuing Ignite. Dwight will be speaking for that time, working with sellers. And then on Tuesday next week, we have John DaCosta coming back on to talk about numbers. And he will have a lot of good insights, and we'll be helping to also supplement what he provides. And then going into next Wednesday, email campaigns with Tanya. And we're working on the logistics of the CE credit next week, so not much details on that yet, but expect it probably by the end of this week, what's going on there. And then Chantel will be coming back in with her famous command, DocuSign, and zip forms class. So she'll be providing that, especially for new agents. That's a good one to jump into if you're wanting to know how all of those work together. And then we haven't done this for a while. Man, when was the last time we did this? So we used to have happy hours once a month in the office, and then COVID hit, and then we did this kind of Zoom happy hour that we did once a week, and we kind of died down over time. So now we're excited to have a happy hour again. And so this will be an in-person and Zoom one. So we'll have it probably in the bar area here in the office and in the training room area. So then, but if you feel more comfortable with Zoom, we'll have a Zoom camera up so people can kind of participate vicariously with your drinks. So that's all for right now, but stay tuned for later this week to see what's coming in at the beginning of November, and it'll be exciting. So
awesome, Austin. Thanks so much. Yeah, we have lots of good stuff ahead. All right, so today we have a great special guest, Mike Larson. He is a CPA, and you've been a CPA for 35 years, is that correct?
Oh, probably a little over 40.
A little over 40, okay.
We're not wrong. It is over 35, so I mean, you know.
Okay, and actually, yeah, Dwight, do you want to introduce him?
He's not just a CPA, he's a CPA to the stars. Right? He's also an author and a jack of all trades. He does it all.
Yeah.
Great. And so, yeah, today he's going to help talk about taxes for realtors. You know, there's probably a lot of things that people are missing, and it's a little bit more complicated being self-employed. So Mike, thank you so much for being here, and let us know if you need help sharing any screens or doing anything. Otherwise, take it away.
Okay, well, let me start by introducing myself. I am Mike Larson. I'm an Oregon native. Been in public accounting since 1980, started with a local firm in Bend for 3 years, moved to New Orleans, was with Deloitte Haskins and Sells, one of the big 8. Moved back to Portland with Arthur Young, which became Ernst & Young, spun off, started a practice with 2 other individuals, left them in 2000 and started my own practice. I was primarily on the tax side of the business, particularly when I was with the national firms. But when you move into a smaller business, you have to be a little more of a jack of all trades. My practice is dealing primarily with entrepreneurs that take a lot of risk and have unusual, interesting ideas and ways to exploit them. And so we get into a lot of different things, a lot of different entities, and a lot of different types of transactions. So I'm going to go ahead and share my screen, and then I've got an agenda. If you have questions you want to take it another way, let me know.
Thanks, Mike.
Yeah, let me see if I can find it. Okay, I got to do this. Okay. Okay, so can you see that? It's kind of small. I'm trying to get it to get bigger. Okay, well, this is what I'm going to have to do because I'm just not technologically up to it. So you can see these.
We can see it, but we can see lots of the little slides. Are you able to zoom in on your computer or click on one of those slides to make it bigger?
That's what I'm trying. I'm going to click, and it's not. Let's see. There we go. There's better. Okay.
Perfect.
Okay. So all businesses kind of start with revenue and expenses, and your revenue is pretty well understood by you, I'm sure. It's percentages of sales. On write-offs, there's all kinds of write-offs. The basic rule is if it's reasonable and necessary and approximately related to the trade or business, you can claim the deduction. That can be subscriptions, education, it can be retirement plans. Vehicles are a little unusual. There are limits that are pretty significant on what is called a quote-unquote luxury vehicle, which is basically any car that costs more than $15,000, $16,000. If you have an SUV that's rated with 6,000 pound capacity or greater, there's expanded deductions. There's 2 ways to deduct vehicle costs. There's per mile, which is about 56, 57 cents a mile right now, or you can take actual. And when you take actual, you look at your business miles compared to your total miles, create a ratio, multiply that against the total cost of your car, which includes depreciation, insurance, gas, maintenance, licensing, and you can claim that deduction. In the long run, over a 3 to 5 year period, generally it works out to be pretty similar either way. One of the disadvantages to taking actual deductions since the Tax Reform Act of 2017, it used to be that if you sold a vehicle and bought a new vehicle, the trade-in could be tax deferred. Your basis in the new vehicle included whatever you paid for the new vehicle out of pocket, plus whatever basis was left in the old vehicle. Under the new rules, you can't do an exchange, tax-free exchange of vehicles. So you can actually have a gain that you recognize in the year that you exchange your old vehicle for your new vehicle. Gifts, when you give gifts to clients or other influencers, you're limited to $25 per person per year. Meals and entertainment, meals are deductible 50% of the cost as long as you properly document it. If it's under $75, you don't need a receipt, but you need to have a reasonable description of where, when, and why. If it's entertainment, like Blazer tickets, it's fully non-deductible since 2017. Home office, if you do not have a primary place of business like a desk in a building, and your primary place of business is in your home, and this space in your home is used exclusively for this trade or business, then you can write off a portion of your home cost based on the ratio of that space to the total space of the home, including depreciation. If you take depreciation, then when you sell your house, that depreciation is recaptured and taxed. There's an option to take a $5 per square foot cost as your home office deduction, and then you avoid the depreciation calculation. Retirement, there's all kinds of retirement plans, SEP plans, simple plans, 401k, defined contribution, defined benefit. The key to them are, I think, number one, when you're getting later in your years, defined benefit starts to make a little more sense because then you're setting away money that's actuarially calculated to get you a benefit in the future. So that's why it's a defined benefit, because you're paying based upon the benefit you want, versus a defined contribution, which says, here's the max you can make this particular year. Being a real estate professional has advantages. Normally, real estate rental activities are passive activity. Passive losses are limited to passive income in a lot of settings. But if you're a real estate professional, you can make an election to treat all of these real estate activities as one activity, convert it from a passive activity to an active activity, and take rental activity losses against your trade or business income. In order to be eligible for a real estate professional, you have to meet two tests. Each year, more than 750 hours of work that you put in has to be real estate professional, and more than 50% of all hours. So for example, if you have a person that has two jobs, and one is a real estate professional, one is a bartender, and you put 1,500 hours into bartending and 800 hours into real estate, you'd fail the 50% test. But if you had 800 hours into real estate and 700 into bartending, you'd pass the 50% and the $750 hour test. You make the election to treat all these activities as a single activity, so all your hours on all the activities count towards the 750 hour test. You're not subject to self-employment tax on the real estate activity, and you're not subject to the net investment income tax. So about 10, 15 years ago, the IRS or the Congress added a Medicare tax on investment income if you exceed certain income levels and you have certain types of investment income. Real estate activity is typically considered investment income, but if you make this election, it isn't. There are a lot of different ways of structuring your business, and they're all geared around entity type. And there's two levels of entity type that you need to understand. The first is state designation. And in Oregon, you can have a limited liability company, limited liability partnership, general partnership, limited partnership, trust, or corporation. Generally, trust isn't going to matter to you for your own personal business, so it leaves the other entities. The first four, all the partnerships and limited liability company, are generally taxed the same, and so you can kind of lump them together into a single category. Once you've chosen one of those categories, then for tax law, it has a separate designation. So for example, if you are a limited liability company, you're the sole owner, it is considered a disregarded entity by default, and you're treated as a sole proprietor, just as if you have no entity at all. The primary advantage of having the limited liability company is liability protection. If the limited liability company or partnership has two or more owners, then its default designation is a partnership. And a partnership doesn't pay taxes. It accumulates income, passes the net income out to the owner on a Schedule K-1, and the owner pays the taxes. Regardless of whether you're a corporation or one of the limited liability partnerships, there's an election that can be made to be taxed as an S-Corp. And the S comes from the chapter of the Internal Revenue Code that defines the rules around an S-Corp. If you're an S-Corp, You're required to pay yourself reasonable wages, which are obviously subject to payroll taxes. And you file a separate tax return reporting your share of the income from the S Corp, just like a partnership income flows out to you personally. It doesn't get taxed to the corporation most of the time. The primary reason people will pick an S Corp over a disregarded entity or a partnership is it's more beneficial for payroll taxes. If you're a disregarded entity or a partnership, you're subject to self-employment tax, which is the equivalent of FICA and Medicare, both the employer and employee share on all the income. In an S Corp, you're paying wages, which is subject to employer and employee FICA and Medicare. But the net income above that, which is shareholder income, isn't subject to those employment taxes. Generally speaking, until you get over 150,000 or so of regular income from the trade or business, when you work through the math, it's generally, you got to hit about 150,000 recurring before economically it's beneficial when you compare the tax savings to the cost of filing another set of tax returns and the cost of running payroll for yourself. A C Corp is a corporation that hasn't made any special election. It is not a pass-through entity. Instead, it pays taxes on its net income. And then if it has excess cash and the owner wants to pull it out, it's treated as a dividend and taxed a second time. Right now, C Corp tax rates are pretty low, 21%, versus in the past they've been 35% plus. So a lot of people, if they're trying to retain capital to leverage the activity, they will be a C Corp so that they can build that wealth faster inside the C Corp. That having been said, if you build wealth and just retain cash, there's a personal holding company tax. So you have to accumulate cash in order to do something like buy a building or buy a business or expand your business. Uh, 2017 came out with some new rules, a new deduction called the qualified business income deduction. In essence, if you have a qualified business, you can claim a special deduction of 20% of the net income from that trade or business. There are other caps. It's not just net income, but you can't exceed 50% of wages paid in that business, or 25% of wages plus 2.5% basis in property. If you're a service business, then there are caps based upon adjusted gross income. Real estate professional is not considered a service business for purpose of this test. There are special elections you can make, particularly with real estate. You can group different types of, for example, if you have multiple residences that you're renting, you can group them as a single group. The advantage is they're treated as one bucket for purposes of income and expense allocations. And then there's the safe harbor rule that says there's always been a challenge for the IRS to define trade or business around real estate. So for example, if I own a hotel, I'm clearly a trade or business because I'm in the trade or business providing space for short-term periods. But if I have a residential rental, I'm generally not considered in a trade or business. But if I have multiple trades or businesses, it's unclear when the line you cross to be a trade or business. If you own one single rental, and you're not a quote unquote trade or business, you're not eligible for the qualified business income deduction, except there's a safe harbor election. The safe harbor election says that if you and other contractors that you employ spend 250 more hours on the property during the year, then you can elect for it to be a trade or business. It can't have a triple net lease. And if you pay people to perform services, you have to submit Form 1099 for those services. And there's an annual election that you have to sign and attach to your return when you file your return. Yeah, in your business, you run into people that are always trying to look for tax strategies. One of the major tax strategies in real estate is a 1031 exchange. A 1031 exchange says that, where it originated was person A would have a property and they'd want to trade that property for property held by person B. And the government said, well, you can do that tax-free because you're really not changing your economic position. You're just trading real estate for real estate. Well, eventually there were court cases that said, well, we're essentially doing that. We're just selling our property, giving cash for another property. We should get 1031 treatment. So the government came out with Section 1031, which is a safe harbor. So safe harbor means you can win based on the merits, even if they're inconsistent with 1031 code section, but it's fraught with danger and it just really doesn't happen anymore. So you really do want to comply with 1031. In a 1031 exchange, when you sell the property, you don't take possession of the proceeds. They go to an exchange company and the exchange company holds those proceeds. You have 45 days from the date of sale to identify replacement property, and you have 180 days from the date of sale to actually complete the purchase of the replacement property. Now, real estate of any kind can generally count as like kind. So you can sell a residential and buy into commercial, and you can buy a leasehold and exchange it for a actual ownership of property. It can be raw land, it can be depreciable buildings. And where people get messed up is if they miss one of these dates, or they try to pull money out when they're not supposed to. One of the risks in the 1031 exchange is if there's a lot of personal property that's been depreciated, you can't exchange personal property for personal property in the other building. So you have to be watchful for that. There's also, since 2017, a new set of rules called opportunity zones. Opportunity zones are areas designated by the federal government as needing investment. It's very broadly defined. There are lots of companies that have set up organizations to take investment money to put into opportunity zones. And there are a lot of rules around what that company can and can't do with the money. The way it works is you sell a property at a gain. You don't need an exchange company. You can take possession of the cash and hold it. And you essentially have 180 days to put that money into an opportunity zone. The way it works is you don't have to pay taxes on the gain today. If the money is left in the opportunity zone for 5 years, there's a 10% step up in the basis of the property, so you reduce your gain by 10% or more. If you leave it in for another 7 years, there's another 5% step up. And if you leave it in for 10 years, there's no tax on the original gain, only tax on the appreciation since the date you put it into the opportunity zone. Now, at 10 years, you have to pay tax on the post-contribution gain, whether you pull it out or not. So a couple of the challenges with opportunity zones in my mind are, one, when they're set up initially in the last year or two, there was a lot of money rushing in, there was limited real estate, so did these opportunity zones overpay for that real estate? Second, as you hit these points where you have to pay taxes in the future and you have to pay it, if people need liquidity, there's going to be pressure on these opportunity zones to sell property to provide liquidity to their investors who have to pay their tax. And that's pretty much what I was prepared to talk about. Any questions or other things you want to talk about?
Thanks, Mike. Can you talk a little bit more about, you mentioned if you're making over 150,000, then it might make sense economically to consider the S Corp. Can you talk a little bit more about that? And as far as like, is that the 150 gross or net, or like a little bit more about that to help people make those?
Sure. So I was talking 150 net. And so if you're making 150 net, the FICA and Medicare tax is about 14-15%, up to 140,000. and everything above that is taxed at 3.5% for employment taxes. If you have an S corp, you have to pay reasonable wages. The case law is pretty sparse on what is reasonable. It's very clear that if you pay yourself a nominal wage, that's not reasonable. And so generally speaking, if you're the sole employee, I think if you go below 70% of your net income as wages, you're taking risk. So at 70%, you're paying yourself 110, 115,000 of wages, and you're taking 30, 40,000 out as shareholder income. The self-employment tax savings on that 30, 40,000 is going to be about 3,000 to 5,000, depending upon the employment taxes at the time. But if you're paying a payroll company, $50 to $100 a month to do payroll services, and you're paying an accountant $1,000 to $2,000 a year to prepare an S corp tax return, then you eat into that profit and it stops to make sense pretty quickly. So once you get above that, then the spread between the employment tax and the administrative cost starts to lengthen and becomes more palatable. Now, there's no difference in terms of benefit plan, tax treatment, like retirement plans and health insurance between the two. So there's no distinction there. It really is just a straight employment tax versus administrative cost calculation. Now, if you employ other people in your business, then you can argue that they're generating some of your profit, and you can start to spread how much compensation you pull out as wages versus the 70% rule. So you could get to a point, if you have enough people generating value, that you've got about 30% coming out as wages. Then it starts to make more sense pretty rapidly.
Thank you.
Mike, I have a question. Would you clarify on gifts? You said on gifts it's $25, but I think we need to be clear that you could spend $100 on a gift, but only $25 is deductible. So would you just speak to that?
Sure. So that's exactly right. I can spend as much money as I want on the gift, but for tax law purposes, I'm only allowed a $25 deduction.
Great. And then I would ask you to go back to the section where we have tax and we have real estate activity, because that's one of the reasons why I wanted you on, was I wanted you to speak to how a realtor can shelter their income differently than other industries if they own a rental house or 2 rental houses or 3 rental houses. Could you go to that section?
Yep. So as a CPA, I'm not eligible for the real estate professional rules. And if I own a rental that was losing money, it's by definition considered a passive activity. And generally, I can't claim the deduction for that passive activity against my active income from my accounting practice. So that loss is deferred until either I sell the property or I have passive income from some other activity. So I don't lose it, but I don't get current value for it. As a real estate professional, you can buy this real estate, generate losses primarily through depreciation, and you can make this election and you can currently deduct those losses against any sort of income. So you get a current tax benefit by making the election and owning real estate.
So Mike, suppose that I buy a $500,000 rental and I assign 25%, or let's say 20 for the math, to the land. So I have 400,000 in depreciable assets. Let's say there's no personal property involved. Can you explain what that depreciation value is in year 1?
So the rule is that for residential rental property, depreciation is claimed straight line over 27.5 years. So based on Dwight's description, you can claim 15,000 of first year depreciation deductions. And I'm sorry?
How about the property?
Property taxes, did you say?
Yeah.
Yeah, so you can also deduct property taxes, interest on the mortgage, insurance, maintenance costs, any cost that's approximately related to the ownership of that property. And so a lot of those costs are cash, but the depreciation is not cash because it's sort of blended into your mortgage. And the advantage is early on in your mortgage, you're paying very little principal and a lot of interest. And so if I have only the mortgage and depreciation, and the principal I pay on the mortgage is $1,000 the first year, but I have a $15,000 depreciation deduction, and I collect $1,000 of rental income so I can pay that mortgage, ignore interest expense, all that other stuff. I have $1,000 of income and $1,000 of cash from the rent. $1,000 of cash went to pay the mortgage, but on my tax return, I report $1,000 of income and $15,000 of deductions. So I get a net deduction in the first year of $14,000. Now the disadvantage of this strategy, there's a couple. Well, it depends on your definition of disadvantage, but eventually you're paying more principal on the mortgage than you're claiming depreciation. At that point down the road, 10, 12 years, 15 years maybe, you have phantom income because you're collecting $20,000 of income to pay $20,000 of principal on the mortgage, but you still only allowed $15,000 of depreciation deductions. So you have $5,000 of income with no cash to pay the taxes. The other strategy that people will use is every few years, they'll refinance the real estate rental and pull cash out. So now their interest expense goes up, their mortgage payments go down, they still have depreciation expense. The key there is there are rules on determining how the interest expense on the portion of the new loan that was taken and used to take cash out, whether or not it's deductible. There's a tracing rule. So if it is basically traced back into paying operating costs, it's fully deductible as a rental cost. If it's used to buy tickets to a football game, the interest expense is non-deductible. So you've got to be careful how you deal with pulling cash out of a refinance.
Thanks, Mike.
You're welcome.
Does anyone else have any questions about taxes or personal investments or anything for Mike?
Mike, I do again. And this comes up all the time for me, multiple times a year. Would you talk a little bit more about tax deferred exchanges? This is an opportunity that's pretty much untapped in our company. And the question that comes up often is owners don't realize what is included in the category of a like-for-like exchange, i.e. land versus a home versus a hotel versus that sort of thing. So can you speak to like-for-like?
Sure. Yeah, so in a 1031, it only applies to trader business or investment real estate. So for example, if I sell my home, my personal residence, it's not trader business or investment, therefore it's not eligible for 1031 exchange. Now there's another code section that exempts the first 500,000 of income on my home if I'm married, filing joint, and I meet a 2-year rule. But it's not eligible for a 1031 exchange. The types of unusual things that you see in a 1031 is sometimes people will sell a leasehold interests. So I'm a business, I operate, I've got a sweetheart deal on my lease, so valuable, so under market that I can sell it at a gain. I can sell my lease at a gain, and I can reinvest that into a building and get a 1031 exchange. What I can't do is, if I'm a developer and I own real estate land, raw land that I'm subdividing, that I cannot sell and convert into a 1031 exchange. But I can sell my interest in a commercial building and exchange it for a residential rental. I can't sell an interest in a partnership that owns real estate and reinvest it in 1031, because a partnership is considered a security, not real estate. If I have a partnership that sells real estate, it's the partnership that has to reinvest it. It can't pass out to me. And there are rules about when property moves in and out of a partnership, determining whether it's eligible for 1031. So for example, in order to exchange property, I have to hold both the property that I'm disposing of and the property I obtain as trade or business property. And the rules say it's all about intent. So for example, if I buy a piece of property and immediately exchange it, and I knew all along I was going to immediately exchange it, it doesn't count because I didn't hold it for trade or business or investment. If I acquire property that I know I'm going to sell real quickly, then it doesn't work. So the general rule is, when you do an exchange, you want to wait 2 or 3 years before you do a sale and another exchange, or the first exchange will be tainted. There are exceptions to that rule. For example, if I sell a home and then exchange it for another home that it's a rental, and my intent at the time of the sale is to hold it indefinitely, but the day after something happens that puts me in economic crisis and my financial circumstances change, I can prove that my decision to sell the replacement property shortly after acquiring it was not anticipated at the time that I acquired it, and therefore I haven't tainted the 1031.
Mike, would you elaborate on specifically? You spoke about this, but I'm not sure it's clear. So if 3 people go together and they buy a property in an LLC for the protections, you explain this, but would you explain it relative to LLCs, because that's what we typically see in our business that we're doing?
Yeah. So the 1031 test, if 3 people form an LLC, it buys real estate, decides they want to sell the real estate, it's appreciated, there's a gain. It's the LLC that's treated as the tax person for purposes of the 1031 exchange, not the 3 owners of the LLC. So the property, if sold, has to be reinvested in like-kind property and held by the LLC in order to meet the 1031 test. Where you run into challenges is partner A doesn't want to enter into a 1031. They want to take their cash and get out of the deal. Partners B and C want to stay in the 1031. If you do, or partner A wants to do a 1031 into property C, and the other 2 partners want to do it into property B. So there's strategies that are built around trying to make those things happen. So for example, the partnership can buy 2 replacement properties, and the partnership or LLC agreement can be written so that there's different types of units. There's A units and B units. Partner A owns 100% of the A units, which is equal to 1/3 of the partnership. Partners B and C own B units, which is equal to 2/3 of the partnership. Units A track to property A, which is the property that A wanted, and B units track to property B, which is the property that B and C wanted. That way you can kind of get what you want economically. It's more challenging when A wants his money out because the first dollars not reinvested are taxable. So if I sell a property for $100, it's all gain. I sell a property for $100, my basis is $70. I only reinvest $70, then the entire $30 gain is taxable. So it's only after I've reinvested more than the basis that I start to defer the gain. There's also use of tenant in commons. So A, B, and C, if they were thinking in advance, could have each set up their own separate LLC. Their separate LLCs could have bought a tenant in common interest, which means they've got a slice of the building only. And there's all kinds of rules to say around whether a TIC or a tenant in common is a partnership or a separate real estate ownership you have to take care of. If I do that and each A, B, and C just own a piece of the building rather than own a partnership that owns the building, each of them can do 1031s out of their TICs independent of the others, although generally speaking, if A wants to do that, partners B and C want to make sure that whatever person is replacing A in their ownership is going to meet the requirements of owning that interest, meaning they don't want someone that doesn't have any money coming in and you lose a tenant and everybody has to kick in capital to cover cash shortfalls. If replacement of A doesn't have the money to perform, then it puts B and C at risk. So you have to be careful there.
Good input. One last question. So what do you think is the most common deduction that real estate agents miss?
Well, so the real estate agents I work with all get the deductions. I would say that, you know, I think the better question is, what are all the types of deductions you can take? And if you look at Schedule C, there are a list of categories of expenses. So employment taxes for staff, auto, rental of space, home office, dues and subscriptions, licensing, publications, meals and entertainment, travel, all those things are allowed. At that point, it becomes a sense of creativity. So if you have an expense that you've incurred that is related to the trader business, is proximate to the trader business, and you can prove it provides value to the business, then you can claim it. You have to be careful if you're going to educational classes in other states. There are rules around, for example, if I go to Hawaii and take a course, and I go there and I'm there 3 business days, and all 3 business days I'm in class, then I can claim the entire cost of the trip. If I'm there a week and including 5 business days, and only 2 of those business days are in the class and 3 are personal, then there are significant limitations on what portion of the trip I can claim. I can't claim the travel because it's less than 50% trader business. And I can only claim the costs associated with those 2 days that I'm in Hawaii and involved in that trader business.
Thank you. And then Robin asked in the chat, are there any new rules on the home office situation? I know you touched on that.
Yeah. No, rules are pretty standard. They've been around for a while. You can either take the per square foot, or you can take a percentage of actual. Key is it's got to be a space that is used exclusively for trader business. It can be a desk in a corner, or it can be an entire room. And you can't have another location where you have an office or a desk.
Thank you.
Mike, I'm asking you questions that I run into fairly regularly, and so I want to ask you a couple more that I think our people need to know. One is, what happens to someone in Portland that has a rental house that they've had for several years, and they want to land in Palm Desert in retirement, and so they sell that rental house and they do a tax-deferred exchange into a house in Palm Desert that they really, really want to live in? Would you explain how that works?
Sure. So you can do that, but remember the replacement property has to be used, your intent has to be to use it as a trade or business. So you definitely, for the first 2 or 3 years, would not want to convert it into a personal use, exclusively personal use. You can use it personally for 14 days a year and not be impacted from a tax perspective. Oregon is going to say that when you sell that new home, you're going to have to pay Oregon taxes on it. Most states say that. If you sell a home and then you do a 1031 out of state, you still owe taxes on the disposition of the replacement property to Oregon. Your basis in the replacement property is going to be a function of your basis in the Oregon property. And there are limits, and I think it's 5 years. You can't convert a 1031 exchange into a solid personal use without getting into challenges. Then when you sell it and you've used it 2 years as a personal residence, there are limits on how much of the personal residence gain exclusion you can use. And I don't remember the rules off the top of my head, but if you're going to use that strategy, you're going to want to sit down with your CPA and walk through what your strategy is. Make sure that it's okay under 1031 and make sure you understand the tax implications downstream.
Thank you, Mike. I do have one more variation of that. And I have my clients doing this. That's why I want everyone to know that at least have a concept in their mind that this can happen. So someone in one of my clients has a rental house and they really don't care to have any more rental houses. And so in Portland, they sell their rental house and they exchange that into another house that they really, really want to live in. Let's say in Westland, they sell a rental house in Lake Oswego and they buy a dream house in Stafford, and they do a tax deferred exchange, and then they sell their personal residence, take the $500,000 exclusion, and in 2 to 3 years move into the Stafford house. Would you speak to that?
Yeah, so the rules are going to be pretty similar to the rules on the previous analysis. The sale of the principal residence that they're leaving, as long as they meet 2 out of 5 rule, they get the $500,000 tax-free. Any gain above $500,000 is subject to current tax, but it's a capital gain. So theoretically, they could take that incremental dollars and invest it in an opportunity zone and defer the tax on that. The conversion of the Stafford home into a personal residence, you got to make sure you don't do it with, I would suggest in that strategy, you wouldn't want to do it within 3 years of the acquisition of the Stafford home, because that's the statute of limitations generally for tax. So I file a tax return, the IRS has 3 years to examine that return. And after 3 years, they have to meet some special rules to go back further than that. It generally wouldn't work. And in 3 years, you're going to pretty much show that your intent is was to hold it as trade or business. You would want to rent out that Stafford home if you can, or at least offer it for rent. You want it to look and feel like a rental and not a holding place for you personally in a couple of years.
Thanks.
And it's a facts or circumstances analysis, so there's not like hard and fast rules on some of this stuff.
Yeah. And Cameron asked us in the chat, so regarding travel, can you define what the minimum requirements are to write the trip off? Portland, Central Oregon, you know, anywhere, like just like 1 or 2 day trips?
Mm-hmm. So if I'm traveling outside my home location and I am spending the night in the other location, and all my business days are more than 50% business activity, then I can deduct my mileage driving or the cost of airfare to get there. I can deduct my hotel, and I can deduct my meals up to 50%, and I can deduct all my other costs that I incur while I'm at that location. Key is you got to document your business hours during business days.
So 50% of the business hours of the business days.
Yes. So if you spend more than 4 hours, then that counts as a business day.
Okay. And then are there any requirements of like how far you have to go? Or is it the overnight, the benchmark?
You have to leave your home area. So if I'm a resident of Portland, I have to leave Portland metropolitan area.
Okay. So would like Vancouver not count? Because that's kind of part of
I would think Vancouver would not count.
Okay.
Unless there's like a seminar there and you're going to stay at a seminar, and part of the value of the seminar is networking with people and staying on site, then I think you could argue that the overnight there would be part of the cost.
Okay, great. Good question, Cam. You have anything to add on to that, Cam? Nope, he says. Awesome. Mike, thank you so much for joining us. You're a wealth of knowledge, and this is really helpful. So we appreciate it. If anyone thinks of any last minute questions, go ahead and put them in the chat. And Mike, feel free to stay on while we just wrap up a couple other little things, but we really appreciate you joining us today.
Can I ask one question?
Oh yeah, wait, Dwight has another question.
Mike, are you taking new clients?
Yeah, pretty much. If you're not taking on new clients, you're shrinking, right?
Yeah. At our age, yes.
I love it. I love it. So yeah, so if you're interested in getting in contact with Mike to answer more of your questions, it's a good time to get organized, right, with your taxes. So we'll share that. So awesome. Good question to ask that. A couple other last minute things before we end our call today. Thanks, Mike. I just want to give a shout out to a couple people on our call right now. So Ryan Purdy, we're excited that you're on. I know you're coming in. I think you're joining us. Wink, wink. I don't know. And then Lester got his first offer accepted last night. So that's exciting. So congratulations, Lester. And Chris Sander just had a new baby boy a week ago. So congratulations, Chris. And if anyone else had anything special happen in the last 2 days, congratulations to you. And then I also want to introduce Jack Gallagher has been with us now for a few months, and he came over from Collier's on the commercial side, and it was a longer transition as far as officially introducing him to the public. But I just want to make sure we really acknowledge Jack. We're so excited that you're here. A little bit about you. He spent over 30 years in real estate, mostly focusing in like malls and shopping centers, all throughout Oregon and the United States. So he is a wealth of knowledge on the commercial side. And Jack, we are so happy to be in business with you. And do you want to say anything, Jack, or show your face live? All right. Thank you, Jack. Welcome. And then lastly, but not least, Morgan from Morgan Creative Services. Give us an update on marketing. What's going on in your world?
So I believe I posted it earlier this week or the end of last week. We're coming up on the holiday season. So right now I highly recommend sending cards out to your database. More people have been working from home anyway, but also I know growing up we would get a ton of Christmas cards. So we were always checking the mail more often. So it's a great idea to send out a holiday card and put your branding on the back of it, or put your business card on the inside of it. So I have a couple pre-made designs available for you guys. Let me share my screen here real quick. So one thing, I have this awesome gift tag. You can put it on closing gifts. If you're an agent that drops off holiday gifts, maybe you do something for Thanksgiving or Halloween or Christmas, whatever, you can put this on the gift, and on the back of it, I can help you make a quick link to get more reviews. The more reviews you have, the more likely people are going to use you. I read reviews all the time when I'm buying stuff. And as far as cards go, I have a happy home anniversary. That's definitely something to celebrate, especially if they're a first-time home buyer. Here's another one for happy home anniversary. And I've got agent branding on the back of these. And then the inside can be blank, or we can come up with something to type in there, whatever suits you and your business, or we can just throw something generic in there if you don't have any big ideas of what you want to put in there. Here is another one for Halloween. Just a cute little card to send out. Inside, happy Halloween. May your day be filled with treats instead of tricks. Just something kind of cute to put on the inside. I've got happy birthday cards and working on some holiday cards, whether it's your family holiday card or maybe you send out a business one and you put your brand on it. Maybe you write up a cute little letter for the inside. This year had a lot of changes, and I'd like to say I started working in the real estate industry this year, or I'm going on my 5th year of working in the real estate industry. I love what I do, and have a couple success stories and maybe what your plans are for your business for the next year. Just something fun as we're closing out the year. Now's the time to think of these. Vistaprint, which is where I do a lot of printing for me, they're having sales right now on printing cards. If I get a coupon and you're ordering something, let me know if I have a coupon. I will happily share that discount with you. I believe right now they are offering 50% off of certain holiday card designs. So if you'd like me to design it for you and help you get it ordered, I'd be happy to do that because these holidays are right around the corner. We're more than halfway through October.
Yikes.
Yeah. I love those, Morgan. Those are so cute. And I think it's cool to give your clients a little bit of personal touch too. Like it's okay to put your picture of your family or, you know, a little bit about your life. And I think that that's really great. And I think you're on it. Like, think about how much more attention you pay to the Christmas cards you get like at the beginning of December versus like 2 days before Christmas, right? So if you get them out early, you know, people will spend more time looking at them. So if you want any like information on that or want to ask Morgan some stuff, reach out to her directly, or she's been in the office like every day, right, Morgan, pretty much?
Yep.
In the ladies' bathroom. So pop into her. And I think you also had some cute like Thanksgiving or Halloween. I mean, you have all kinds of cute stuff. So reach out to Morgan if you have anything you're thinking about.
Yep, this is what I love doing. So pop on by and we'll chat for a little bit. I love this stuff.
I love it too. Awesome, you guys. Well, thank you everyone for joining today and your time, and have a great rest of your day. Don't forget about the LARC class tomorrow and Tanya's class, and have a great week.